my information if you need to follow up with more specific explanation about what we're talking about. And I'm always welcome. I'm always happy to come back and just focus on one specific area if there's a need for that. I am an investment specialist. I work with PFSL Investments. But with that, we also work with the disability, life insurance, along with helping people plan their future, retirement, education savings, home savings, all of that fun stuff, right? So we're kind of full circle, holistic way that we deal with our clients so that they, we're the Costco, I guess, of finance. You can come to us for everything you need, have it all in one place, and have customer client-centric attention. So you will be assigned an agent. That's your person, right? That's going to be able to help you with all those different areas. So today we're going to cover, like I said, life insurance, disability insurance, TFSAs. I've been doing this since 2018. The disability side of things is a little newer to me. We also do the health and dental benefits that some of the folks in your company enjoy with us. So that is also an extension of what we do here. So the first thing we're going to talk about today is going to be buying the right life insurance, because it can be very overwhelming. A lot of people will just avoid the subject, period, because when they get looking for it, they're like, what kind of insurance do I need? What makes sense? Term insurance, there's this one that saves money for me. That sounds like a great deal. How do I start? And is it super expensive? I don't even want to talk to somebody. How much do I need? There's all these questions, right? Where when we sit down with you one-on-one, we're able to kind of take a look at your whole financial picture and figure out what's right for you. Our goal here is to help you learn how to invest and grow your money so that you actually eventually don't need life insurance unless you're looking to have it for a legacy. So we'll just go through the presentation. I may skip slides here and there if I feel they're going to take too much time or they're just not pertinent to today's information. Where did I get that slide? All right. Sorry. Get the right one. I just did this with Andrew. I should be able to get the right one up here. Okay. Andrew, are you seeing the right slideshow there?
Yeah, I got the
one that says buy the right kind of life insurance.
Yeah. It's just not in presentation mode.
Okay, great. I don't know why it's not coming up on my screen. How about now?
Yeah, you're good.
Full screen? Completely challenged here. Okay, so buying the right kind of life insurance, what does that look like? So when we talk about buying life insurance, and again, in our life that we insure, and we're going to cover this as well in the disability, but this is more in the life side of things. So we insure a car, we insure a house. We don't have a choice. By law, we have to have these things insured. But oddly, we are not required to insure our lives. And when I say lives, I mean our income, right? We can't replace a person when they pass away. Like we can replace a car, we can replace a house. What we're looking to do is replace that person's income if they were to pass away. And what would that look like for your family, right? All those things that your paycheck covers. What happens when that paycheck's no longer coming in, and what kind of situation does that leave your family in? So we have a simple solution. You just buy the right kind of life insurance, right? For what you need, to cover what you need for as long as you need to cover it. The purpose is to cover, like I said, your income, what you should value, because what we do is we buy term insurance and we invest the difference of what we would be paying for whole life or cash value, and we put that into proper investments. And who needs to buy it? Anyone with anyone depending on them, anyone with debt, anyone that's foreseeing having debt, right? You might be 35 years old and don't own a house right now, or maybe don't have a family. But if that's in your near future, now it's cheap. So again, we work on the theory of decreasing responsibility. On the left side of the screen, you'll see all the responsibilities somebody will have in their life. They'll have young children, higher debt when they're first getting started, a higher house mortgage. And if that person's income was not there, coverage, because you don't have a lot of money. Moving on, once you get, 20, 30 years into things, you've got your mortgage paid off, your children are grown and out of school, you're not looking at paying for their education anymore. You're just focused on your retirement. So, you're more becoming self-insured, right? You got 600 grand in the bank or in investments, you have no debts except for just your daily living costs. You don't need thousands, hundreds of thousands of dollars of life insurance. So we want to reallocate that money into your growth for your retirement. How much? There's different ways of looking at it. You can do one of two things. So we can look at your debt, your income, your mortgage, and your education and expenses and say, okay, we'll need this much to cover those debts if you were not here. Or you can just do the simple industry standard rule of thumb and just get 7 to 10 times your income. So we actually have a program where we can, or you can, if not with us, other companies that provide it, you can have a step. So you can say, okay, I need $20,000 insured for the next 20 years because patient. After 20 years, I'm not going to need that portion, but I'm still going to have a mortgage. So you can step up what you're going to need for the period of time that you're going to need it. That's probably confusing, but I can explain it better later. What we want to really show you the importance of is if you have life insurance now, or you are looking for life insurance, it's any incentives out there saying, with our insurance, we're not only going to give you life insurance, we're going to start saving your money for you. Yeah.
Maybe kill your camera while you're presenting, just
Yeah.
to get bit.
Oh, shoot.
Yeah.
It's kicking out. Okay, let's see if that works better. Sorry, darn internet this morning. Okay, so term insurance, it's cheaper. It's only a portion of your funds, a portion of money that's going to cover your debts, and it's 100% paid out upon death. Whereas cash value, you're paying more. It does say they're including an investment option. But these plans, what happens with them is your cash value versus your life insurance. The cash policy typically is not paid out at the time of death. Okay, so let's say we have a $200,000 coverage and we've earned or grown $20,000 of investment in there. That $20,000 upon death is actually cash surrendered back to the life insurance policy or company, sorry. That's crazy, right? You put in $20,000, that's your $20,000, but the life insurance company will actually keep that upon death. If you wish to access that $20,000 while you're alive, you can take that money out, but you are actually borrowing your own money. And so that's something you wouldn't do if you go to the bank and take money out of your account, right? You're not going to go and say, give me $50. They're like, fine, we're charging you 10%. Well, that money's out of the bank. You need to bring that back. So it's really important to be educated well on that. It's hard to know, it's hard to understand the ins and outs of whole life policies because they're not explained to you in most cases properly. You don't understand that there's a living portion and a death portion. For example, my father passed away 3 years ago. He had one of these policies. He had $80,000 in coverage he'd been paying for years and years and years, and he had grown about $65,000 in cash value. When he passed, $80,000 was paid out, $65,000 went back to the life insurance company. Seems absolutely ridiculous, but that's something we need to be aware of, right? So that's it. I'm not going to go into this slide because it's really detailed, but basically this is a comparison of whole life versus cash value and how those payouts are. Like I said, you're going to get less coverage with whole life. You're going to be paying more money. And then the cash portion that's built up in there, 90% of the time is going to be paid back to the life insurance company. Whereas we say for the same amount of money you're paying monthly, you're going to get triple the amount of coverage, right? When you die, the full amount is going to be paid off. And the difference that you're not paying for that policy is going to go into an investment, which is going to grow and pay out full amount. So upon death, you're going to get the $300,000 payout plus the 160 that you've grown in your investment is going to be paid out to whomever you wish it to be paid out to too.
Why do Why do all these companies hawk those other ones? Because they make more money on the fees, or
Yeah,
because
so
like
it's kind of
so
like,
many people push that investment stuff, and like I agree with you. Like this doesn't make any sense. Like you make more money and you can access your money by investing in different things, but everybody pushes that stuff.
yeah, so I'll tell you why. So number one, to sell a whole life cash value, universal life, there's all these different names. They rename it all the time. And some of them work differently, but they all have the same end result, right? So what happens with those is when you get a life insurance license, you are able to sell seg funds as a life licensed person. You don't have to go through the motions of getting your mutual fund license. So basically, those policies pay them way more, and they pay them consistently because there's an investment portion. So for me, I would do, if I do a life insurance policy, it's commission up front, that's it, one and done, right? Then I take their money and I invest it. And as it grows, I'll make trailers off of it. It's not even as profitable as cash value, but there's no way I would sell a cash value policy knowing what it does to people. So that is what it is. It's a higher income for the people that are selling it. And that money that the life insurance company is now bringing in those investments, which they're turning around and they're investing in the market, right? And they're making the difference on that investment, much like a GIC. They're guaranteed your money. They take it, they put it into the market. They make a higher interest rate of return than you are because they're going to pay you that tiny bit. And yeah, so it's just way more profitable for the sellers and for the insurance companies than just a cash value policy.
Makes sense. Thanks.
Hopefully that answers your question. Yeah, it's like really, if we get into the nitty gritty of it, it's very stomach churning. That's what I would call it. So again, that's what it is. And you're paying way more for that because, Andrew, it would be like I said to you, hey, pay me $200 a month. And what I'm going to do is I'm going to give you life insurance and I'm going to start putting money away for savings. And you're like, that's awesome. So you're giving me $200 a month. For the first, sometimes up to 5 years, we're not even going to see any money start to accumulate in there. Because what that's doing is that $200 is going straight towards insurance. And it's actually padding your future insurance when your insurance becomes more expensive and your cash isn't even growing. So
Yeah.
you come to me at year 4 and say, hey, Trish, I want to take money out of that. And I'm like, oh, sorry, Andrew, there's no money in there yet. And you're like, what? I've been putting I thought $100 a month into there. No, not yet. We're going to start doing it now. 10 years later, you decide I'm taking the kids to Disney. I need to take out $5,000. Who can go to Disney for $5,000? I don't know, but I need to take out $5,000. And I say, sure, here's $5,000, but we're charging you 8% on your own money. Well, that's out of the policy. You need to put that back into there. And if not, then that's going to come off your final payout when you pass away. So it's really tricky. Again, there's a universal side of it. This is more like a bucket. Again, they're prepaying their insurance because when they're young, their insurance is super cheap, but they're paying the higher amount. That money's going into a bucket to eventually pay out the difference when your insurance becomes higher. But what happens with that is the bucket runs out. So I had individuals come to me and they're at the age of 55 and they're like, we've been paying this crazy amount of life insurance. And now they're telling me we have to pay them $15,000 to pad that life insurance policy because there's not enough money in there to cover us anymore. If we don't do it, it's terminated. And then it is. So it's just crazy. So it's really important for you guys. So you kind of know the difference and that's for your own kind of learning, understanding, checking what you have in place, talking to your friends and family, seeing what they have in place. But what I want to help you with is because you're a real estate agent. So you're out there helping people. Another really dark part of life insurance or insurance, nobody likes insurance anyways, but another dark side of insurance is when somebody goes and gets mortgage insurance. So I'm not talking mortgage protection like CHM, what is it? CMHC? CHMC. Get it mixed up with radio station.
DMA.
Yeah. So not that. I'm talking when you go to the bank and they give you your mortgage for 600,000 and they say, you need to insure this and you're going to pay for that insurance. So if you die, your mortgage is paid off. That sounds amazing, right? But what happens is is when you take that mortgage insurance out with the bank, you're only covering the mortgage. So you're actually protecting the lender. You're protecting the bank. So if you have a $600,000 mortgage and you're 25 years old, you're, great to be 25 years old and have a $600,000 mortgage. So maybe that's not right. So 35 years old and you have a $600,000 mortgage. The bank's going to say, hey, sure, you need to pay us $200 a month to insure your mortgage in case you die. Then 5 years later, your mortgage has come down to what, 598? No, let's say 560. And your age has gone up 5 years. You're now going to be paying, your insurance gets reset at your new age. So essentially your mortgage balance is coming down, but your premiums monthly are going up. Does that make sense? So in the end, you could be 55 years old paying $300 a month to cover $50,000 left on your mortgage. It's ridiculous. It's a crazy scale. And then there's some other fun stuff about that. So in this case, what is mortgage insurance? It's offered by the lender, the bank, the mortgage company that's giving you that. What it does is only pay off the remaining balance if you pass away. You don't own the policy. The bank owns the policy. Your coverage declines with the mortgage balance, and the lender is the beneficiary, not your family. So when you die, that mortgage money doesn't go to your family. That goes to the bank to pay off your mortgage. Okay. So what is personally owned life insurance? So again, we're talking term insurance because that's what we want to focus on. With term insurance, you own the policy. You get to choose who the beneficiary is, your child, spouse, best friend, dog, whatever. The coverage stays the same for what you take it out for, regardless of whether your mortgage goes up or down. It can be used for any purpose, not just the mortgage. Meaning, if someone passes, if a husband, let's say the father of the house passes away, life insurance, it doesn't automatically go to pay the house off. It goes to the beneficiary, let's say in this case, the mom, and she gets 500,000. She may say, you know what, I'm still working. I'm okay to cover the mortgage at this point, but I am concerned about my kids' education. So I'm going to put $100,000 away for that. I'm going to pay off my car. I'm going to take my kids on a trip and maybe put some money. She gets to choose where that money goes, right? And that's super, super important. Because not paying off your mortgage doesn't solve life's problems, life's daily living, right? She can take that and say, listen, my husband brought in $5,000 a month. I'm going to invest that money and I'm going to pull $5,000 a month to replace his income. How great is that, right? I mean, when somebody loses a spouse or someone like that in their life, it's terrible. And so upon having this emotional devastation, they're now faced with this financial devastation. And this is one way to at least take care of the financial devastation, right? It's one way for the person to take a deep breath and say, okay, we're just passing. It's usually cheaper and it's underwritten at the time of application. So this is really, really important, guys. When you get your life insurance, it is based on your age and your health at the time that insurance is taken out. Mortgage insurance, there's so many documentaries on it. Mortgage insurance, when you die is when they assess whether or not you actually qualify for it. So there was a CBC article quite a while ago now where they had a bunch of couples on a dance floor. And every time somebody was disqualified from getting their mortgage covered because, oh, Joe had a heart condition. Oh, Mary said she was never tested for or for blood pressure, but she was. At the end of it, there was like 3 out of 50 people on that dance floor that actually would have gotten their life insurance covered. That is unbelievable. And imagine waiting for that. Our policy, we will pay out life insurance typically, unless something's wonky, within a 14-day period. These mortgage insurances, they will go on forever before they even decide whether you qualify for it to be paid out at the end. So here's a kind of a breakdown. Who owns it? If it's mortgage insurance, the lender owns it. Life insurance, you own it. Beneficiary is the lender. Life insurance, private life insurance, your loved ones or whomever you wish to leave it to. Coverage decreases with the mortgage. Life insurance stays as to what you take it out as. The use of the fund only pays the mortgage. Life insurance, you get to decide. So let's say you have your mortgage with BMO and then you go to Scotiabank, you have to start that process all over again. Life insurance, it's going to stay there with the policy holder, with the company that you have taken it out with. It's transferable, or like it just stays with you, I guess. And the underwriting is after death, post claim, whereas life insurance is at the time the policy starts. So again, what would you choose? Bank owned mortgage insurance, because that protects the lender, or personal life insurance, which protects the loved ones. So basically, mortgage versus personal, we want personal. Then when we get to personal, we want term versus whole life or cash value. Okay, so those are the important things that you as agents need to know for yourselves, 100%. But you also want to share that with your clients, right? When I go to get a mortgage, I go in and they know I'm in finance. They're like, I have to by law tell you, you need mortgage insurance, or like I have to offer mortgage insurance, but I know you don't want it because we know that it's a crappy product. Like that's how the people selling you that mortgage life insurance even view it, right? So just as you're having conversations with your clients, just say it could, because it's just extra added value that you're giving your clients, right? It's service that you're providing them. Hey, when you get to that mortgage and they talk to you about mortgage insurance, you really need to consider a life insurance policy outside of the company that's lending you that money. So that's that on that. That took what, 20 minutes or so.
Yeah, you're good. Yeah, and even like if you use a mortgage broker, they will specifically tell you like, don't take this product. But if they're going right through the bank, I've had some banks push it on people. I've had people take it, don't even understand it. You can cancel it though. So if you do have a client talking to you about that and they're like, I don't want this anymore, you can cancel it. But some banks like aren't good at explaining it and they'll just kind of try to sucker them in there for it. Independent mortgage brokers, the ones we use, are very good to tell their clients like, hey, this is going to be on the form. I recommend you do not take that.
That's awesome.
But if anything, like at least push them, hey, do you have an advisor? If not, like Trish is here, somebody else, but get them to talk to somebody that understands all the products, and then that way they can make the best decision for themselves. But that mortgage product, yeah, is not good. So you're better off have a policy that covers your mortgage and more potentially, to leave your family in a better spot. And the other thing banks are really good for is suckering people in to pay off the cheapest debt they have, which is your house. So
Yeah.
like having to pay off the cheapest debt you have does not really serve your wife or husband potentially, because it's like, well, I have a mortgage for 4%, but I don't want to pay all that off. I'm paying credit cards and cars and all this stuff at 18%. It's like better to wipe the bad debt, keep the house, that's good debt, and then you're good. So
And that's a good point, Andrew, because many of us come from, like I'm older, but our parents, their only focus was to pay off mortgages. Now, for me, it's because my parents had 18, 25% interest rates on their mortgages. So of course, that's what they want to pay off soon. And that's traditionally been handed down and ingrained in us. Like, we got to pay the mortgage, we got to pay the mortgage. But that's not necessarily the case. As Andrew said, you maybe have other debts that are higher that need to be paid off. In fact, I have many clients that during the kind of the boom with real estate, when they were selling their properties at a great profit and purchasing other properties, they literally took the money they made from their house, invested it, and had that investment pay their mortgage, because their investment's making 7, 8, 10, 15, whatever percent, and their mortgage is only at like, even at the high 5%. They're making a spread, right? So yeah, there's a lot of things that we have ingrained in us to do certain ways, that we need to actually look at alternatives. It's not for everyone to do it that way by any means, but it is definitely something to think about and to talk to your clients about, just to get a different opinion on it, right? So the next area I'm going to cover, right?
no, go ahead. Sorry.
Go ahead. No, I was just going to start the next, but if you had something else, go ahead.
No,
on that
go on
point.
disability. I'll bring it up after.
Okay, great. So now we're going to talk about kind of this sort of the same, but not the same. It is about protecting your family, but it's about protecting your family while you're alive, as opposed to Wait a second, I did it again. Share. Protecting your family as well, you're alive, as opposed to, having to die before somebody benefits from that policy that you have in place. So, much like life insurance, I hate calling it life insurance for the reasons I said. It's not life insurance. It's your income protection. And this is the same way we need to look at disability, right? You're insuring your lifestyle. You're insuring your paycheck is what you ultimately want to do by having disability coverage. Disability, which can be disability due to illness, it can be disability due to injury. Okay, so again, we do have some BRIX folks that have their health and dental with us. With that, there is a small portion of coverage for if something was to happen to them, but it's very important to look at disability coverage on its own as well. And when you meet with me or one of my reps, it's going to talk about your specific situation. You may be more interested in critical illness than injury, et cetera. And then your income also can factor into there. So there's lots of things that have to be considered when you're looking at lifestyle protection. But what is lifestyle protection? So let's talk about that. So it's about securing your income again, right? What happens if something interrupts that paycheck, an unexpected life event, and all of a sudden that paycheck, that commission, you can't go after it because you're sick in bed or you've broken a leg and you can't get to your meetings, etc., right? So how do we safeguard that? So what is lifestyle? Lifestyle is your cars, it's your home, it's your education, it's your vacations, it's all of those things that we do and enjoy on a daily basis, right? So we need to protect that, because without your paycheck, how many of you here will be able to pay that car, pay for retirement? If you don't have that paycheck coming in, is there anybody here that's still going to be able to take care of all of that? Yes, they may have another spouse, but on your paycheck, what does that take care of? We need to look at that. So it's really living today, but planning for tomorrow, and not only for your retirement, but what about the pit stops along the way where there is injury, there is sickness, there is time that is going to take you away from work because of an event. So your income supports all that. Again, like I said, if you were unable to work tomorrow due to an injury or illness, would your family be protected? Right? Really, really think about what that looks like. Sometimes we have to step out of the picture and not be complacent with, well, that's fine, my spouse still makes money, or that's fine, I'm not going to be sick for long, or this is just a broken leg, I can go wherever I need to eventually, not realizing that can take some time. So step out of your picture and look and see, how important is it for me to cover my lifestyle? So let's look at those. We think, I don't anymore because I'm old and I know I'll break easy, but a lot of us think we're invincible, right? We're healthy, we're strong, we're young. Nothing's going to impact us. I'm good. I have longevity in my family's health. We don't have stroke and heart. We don't have any issues. I come from a long line of healthy, strong people that live forever. But that doesn't cover accidents, right? That doesn't cover tripping and falling and breaking an ankle. That doesn't cover skiing and wiping out, right? What does that look like for you? So if you felt like that, I'm 25, no chance of me getting disabled, let's look at these charts, because it will show you, based on your age, how likely it is that you would be to face a disability. Okay, so there's a high risk when we look at this. So let's say you're 35 years old, right? You're like, what's the risk of disability? I'm 35, I'm strong, I'm young, whatever. It's a 50% chance that something's going to happen to create you to be disabled. I work in a disability area as well, and I always say we're one phone call, one accident, one diagnosis away from being disabled. If you look at it, that's pretty high risk, 35 years old, being 50% chance of being disabled. Let me give you two examples, and I talked to Andrew about these earlier. There's one gentleman, he's an electrician, 34 years old, right? Got the world by its pants. He has a mortgage, he's getting married, he skis, he rides a motorcycle. He has this great life, but no one's going to tell him that there's a chance that he's going to be disabled. Well, guess what? The simplest thing happened. He turned, he flipped over a cup, he snapped his femur and his tibia. He's now off work. He does not have disability coverage, and the company he works for does not have short-term disability coverage, and it wasn't at work, so it's not going to be covered by workers' comp. So he's down to going to the government and asking for unemployment, which he's getting some, right? He's getting the max, which is probably a quarter of what he's making when he's working. Does he wish he had a disability coverage in place right now? He sure does. And that's an injury. Another gentleman I just spoke to, also, I think he's also 34 actually. I'm working with him for a disability savings plan. And he explained to me, I was a hiker, biker, I was healthy. I had one really bad attack. I went into the hospital. I came out with half of my intestines and a bag for the rest of my life and diagnosed with Crohn's. No precursors, no one in the family, no indications, nothing. The job he had was a very physical one. He's not going back to that job. Eventually he'll probably retrain and get something, but he's not going back to that specific job. I asked him, how did you feel before that diagnosis? And he said, invincible. I climbed mountains. I rode motorcycles. Like, he did everything that you would think he would get hurt that way more than something physical. So he was not expecting it, right? Here he is. He's in that 50% range or 54% range, I guess. So not only that, what does it look like if you are disabled? So the statistics show, I can never say that word, statistics show us that if you are disabled for more than 3 months, you kind of jump to the next scale. If you're disabled for 3 months, maybe you've broken a leg, or you've had an injury, or you've had some kind of health issue that's cleared up in 3 months. But they say statistically, if you go past that 3-month period, the average duration that you will be out of work, in our example, looking at a 35-year-old, will be 2 to 8 years, or 2.8 years, right? So that's 2.8 years of your income that you're without. How many of you here could survive without your income for 2.8 years? That's a long unpaid vacation. And I would love to have a 2.8 year unpaid vacation, but that's not happening, right? So we have to think about that. And that's just an average. Some people never recover and they're off inevitably, like they're forever. Like they will never go back to full-time work or to the work that they were doing. And again, it's important, if you guys have WCB in place. Andrew, do many of your folks have that, or do you, as independents, you just don't get the WCB?
Oh, we're all independent contractors, self-employed, so that's why it's really important everybody has their own disability insurance, because they're not going to get covered.
Awesome. Because I know you have an option for WCB as an independent self-employed, but many people just don't. So it is important to go this route, and this route instead of WCB, because this is 24 hours, 7 days a week, right? It's not just a work injury. So let's look at that valuable asset. What is your most valuable asset? I know if I asked Andrew, he would say my kids and my wife. Go ahead.
I was gonna say that's the hardest part, is if you were gonna try to claim WCB, is proving you're actually were working when you got injured, because we just do so many activities during the day that aren't like work as well. So it is hard to convince them to cover you.
So for example, if we happen to be out go-karting and we get injured go-karting, it's a work function, but is it considered work? 99% chance WCB is not going to say, yeah, that's a work injury. So one, you've got to get through all the process, the steps of getting them to even look at your case, then deny your case, then appeal your case. Like, and that's easy. That can happen in, like, you know, it can happen. So we don't want to be WCB for this type of insurance. We want to be personal insurance. And again, it covers you where you go. So your most valuable asset, as I was saying, Andrew would say my wife and my children, 100%. But let's talk about chattels. Like, let's talk about possessions. So if you look at your assets, no, I went backwards. Oh, sorry. We're talking, yeah, sorry, I got ahead of myself. So your most valuable asset really is your paycheck, right? Because regardless, as I said earlier, your home, your car, your trips, your vacation, your kids' education, none of that's going to fall into place if you don't have that income coming in. So how does that, how do we even quantify what that income is over a long period of time? So this gives us a little bit of a breakdown. So let's say, Bill, your income is $60,000 a year, right? And let's say, Bill, you're 35 years old. You feeling 35 today? Yes. Okay, awesome. If we were to look at this chart, if at the age of 35, you were unable to work for the rest of your life, so from 35 to 65, in that 30-year span, you would have brought in about $2,434,000. Okay, you guys, you're real estate agents, you might even be off the chart here at 120. So you can look at what as far as we go here. But so let's say you're 35 and you make 120, that's almost $5 million you would have made in those 30 years. So who's going to pay you that, right? How does that get covered? And so we want to look at how we can get that covered. So we're going to break this down. We all know in Calgary, how many of you guys sell houses for less than 600,000, right? Single family homes, not many, but let's say this person has a $600,000 mortgage and they've got a really good rate. So they're only paying $125 a month to cover that house insurance. Okay. So they're insuring their house in case it burns down, gets flooded, hailed to pieces, whatever the case is, they're paying $125. They have to, by law, again, do that, right? Then they have a car. Again, by law, they have to cover it. $60,000 car. You real estate agents are probably driving, $100,000 cars, no? Okay. But you're paying $225 a month to cover that car, let's say. So your total assets in this example is $660,000. You're putting out $350 per month to cover the insurance of those. How much are you paying to cover your paycheck, which is your most valuable asset? Anybody paying money towards their most valuable asset? Yay, Andrew. That, again, almost by law, that should be a requirement because that is the most important thing you should be covering. So what we want you to do is really consider how it looks to cover that asset, right? So yes, it's a monthly payment, no one likes paying, but if something was to happen short-term or long-term, your income is protected, which means your house, your car, and ultimately your family is protected because you've taken the steps to put some money where it matters, right? Again, being independent contractors, you don't have a company behind you paying this stuff for you, right? You don't have a sickness program with your work. You need to create that for yourself. And that's part of being an entrepreneur, right? It's awesome. It gives us a ton of freedom, but it also gives us a ton of responsibility. And responsibility we shouldn't shrug. And I don't mean to be the world is this terrible place, but again, living for today and preparing for tomorrow is what really matters. So look at what it is, sit down and figure out what your assets are. And knowing that you've protected the house and the car, let's look at what it takes to protect your income, which is your most valuable asset. So again, if I just put in the slides, if I could show you a plan that would protect your most valuable asset and it was affordable, would you take it? There's a lot of factors on that cost, right? So age and amount of coverage, et cetera, but that can all be customized. It's not just a pick up and go. It's a sit down, figure out what is your value, what is your budget, and do as much as we can to give you what you need covered within your budget. Because it's better to have a little bit of something than a lot of nothing, right? When it comes to coverage, even your life insurance. Maybe you have $1 million house and you can't afford $1 million worth of life insurance. If you got something, it's going to be better than nothing. So think about it that way. So again, that's something we can sit down and talk about just to give you an idea of what that looks like for you. Again, not to be touting myself, but to sit down with me, I don't charge anything. It's a free consultation. I can look through where you're at with things. and see what's going to help you move forward. So any questions on that so far? I think there's a couple. Any other clarification?
Who has disability in place right now? Bill, do you have a separate plan? I mean, I know if you just started, which, you know, you can make some money. So you start making some money, definitely look at this. But it's not very expensive to cover your income. It's one of the cheaper insurances, and then at least you have peace of mind. Because yeah, if you break your leg and now you can't even get to showings and you can't work for 3 months, to have the income replaced on your insurance will be a lot easier than trying to fight the government or ask for EI or other stuff too. And it's just covered and you keep going. You got to be able to pay your bills. So this is how you make money now, and your body lets you do that, and you can't really do your job if you can't walk or drive a car. So keep that in mind and definitely like figure out a plan that works for you. And it just, honestly, it's not that expensive. I think I'm paying like $65 a month to cover like $7 grand a month right now. So I need to up it, but that's what I started with a few years ago. Now I got to up it so I can actually cover my income that I need. But at least have something in place so that you have something coming in.
Yeah, that's really important. I said in what you just said, Andrew, is you hit the nail on the head. Your body is what allows you to do what you're doing right now, right? So let's keep our bodies fit in shape. But you know, there's things that'll happen that will interrupt that, whether or not we do our best to take care of ourselves. So the last area I just kind of wanted to cover, and it's a little outside of what we've been talking about, the insurances that are super important. And you know, it's awesome that Andrew got you guys together today, because it is hard to get out there and find resources. And like you said, Andrew, how much is like, you don't see hardly anything about term life insurance out there because it's not sexy, it's not glorious. It's, you know, it's term insurance. You got $500,000 debt, let's cover your 500,000. That's it. That's all, right? Whereas the others, like, we're going to make you money. You can borrow your money. You get this policy, and you can borrow hundreds of thousands. Like, it's just so sensationalized. And really, we got to get to the basics. We got to get to the basics when we're investing our money. We got to get to the basics where we're insuring our lives, and we got to get to the basics where we're insuring our paychecks for disability. So let's stick to the basics. That way, you're also not paying as much because you're doing the basics, right? So the last area I just kind of wanted to cover that I think is an added bonus. You know, you guys may all be familiar with this, so I might be teaching you something you already know, or talking about something you already know, but it's a great conversation piece for you to start, let's say, filling your pipeline, right? We in my industry are always looking for ways to talk to people, to open conversations, to have you put in the back of their head for when they are ready to buy a house. They're going to go, oh, Tina, we talked to Tina about that. Let's talk to her, right? You're not going to get instant, hey, I sell houses. Oh, great. All of a sudden I want to buy a house. You're building your status in that person's mind so that when it comes to time to do that, they're going to think about you. So I'm always looking for ways to have conversations, start conversations. So let's say, Sandy, someone says to you, what do you do for a living? What would you say? Put you on the spot.
Oh, sorry, I was just replying to a text message there.
Oh, sorry.
What
do you do for a living?
I help build other people's futures. Can you hear me there?
Right. So that's something that you want. Sorry, say that again.
Oh, I was just saying, I help build other people's futures.
Awesome, right? And that's where you want to be present, because when you're in a room full of people and someone was talking and like, oh, I sell cars and I do this and that, and then they're going, well, Sandy, what do you do? And when you say, instead of saying I sell houses to people, you're like, I help people build their futures. Like, that is so significant. And they'll be like, oh, well, how do you do that? How do you help people build their futures? the curiosity is raised, right? And then you can go into it, or you can say, well, it's not the time to talk about it. Let's meet at other times. And I'm not telling you how to do your sales. I'm just like different ways to penetrate the market to people that are going to come back to you when they're ready to do what they want to do. So I'll say to my reps, you know what, you can call 100 places. If they're not looking for small business benefits, they don't care. They'll be like, no, thank you. No, thank you. No, thank you. No, thank you. You get 100 calls, 99 of them will say no. One of them will be like, oh my gosh, we've been looking for small benefits. We just didn't know who to go. Thank you for calling. Right. So in that way, Sandy, what I would say for you can now offer, when you say helping people build their futures, how do you do that? So by housing, selling houses, etc. But you can also say by educating people on the FHSA. Do you know about the FHSA? And they'll be like, well, yeah, I heard about it, but how does it work? Right. So this is just something that when you're with a group of people and they're like, oh, I want to buy a house one day, but that's never going to happen. I can't afford it in this market. And they go on and on. Say, but have you looked at the FHSA? What a great way to start saving some income or saving some money to buy that house. Let me talk to you about the benefits of that. And you can just be high level with them. So my goal today is just to give you a little bit of context, a little bit of verbiage, I guess, to talk to those people that you run into to get them interested in that. And again, at the time, they might be like, oh, I'm not going to be able to, why is the screen not sharing? I am not going to be able to, do it right now, but I know Sandy had something in plan for me. So had an idea. Sorry, talk to me about the FHSA. And so I'm going to get back to Sandy to talk to her about that. Once they save that money up, guess who they're going to come to buy their house with, right? You're building those relationships. And that is a huge part of what we do when we're out there. So I don't know. My screen doesn't seem to want to share, does it? Do you see the FHSA benefits yet, Andrew?
Yeah, we can see the slides. We're good.
Oh, that's funny. It's not showing on my side. Okay, let's go here. So we're just going to run through this. A lot of information here. Again, if you guys want more detailed information, I'm more than happy to tell you about it. So the FHSA is a savings. It's a registered savings account. So we know what RRSPs are. We know what TFSAs are. We know what education savings, etc. are. The FHSA is a hybrid between the TFSA, which is a tax-free savings account, and the RRSP. So I don't know if any of you worked with new home buyers before and could purchase a home using a portion of their retirement savings. Okay, now there's the FHSA, which is also for new home buyers. There's a lot of differences in them. So let's talk about that. So with the FHSA, a person can contribute once they're old enough to invest. They can contribute $8,000 a year, up to $40,000 into their FHSA. It can be invested in that vehicle for up to 15 years. And when they take the money out of that FHSA to purchase their new home, their first time home, they are not going to be taxed on that. Okay, so the details are kind of right there in front of you. Contribution room, 8,000 up to 40,000. It can remain open for 15 years or until the age of 71. And there are tax benefits because with the FHSA, it is giving you a tax break like an RRSP would. So let's say Andrew makes 100,000, he puts $20,000, or let's 100,000, he puts $8,000 into that FHSA. He's going to be taxed on 92,000 as opposed to 100,000. So he's going to get that kind of RRSP tax deferral, tax deduction at the time he puts it into that account, which he would with an RSP too. But the difference is when you take out the FHSA to pay it on your mortgage or your down payment, you aren't taxed on it like an RSP, but with an RSP, you have to pay it back within 15 years. An FHSA, you do not. So it's the best of both worlds, a TFSA, which is where you can grow your money tax-free, doesn't cause you any tax penalties when you take it out. But with this, it's giving you that tax break when you put the money in. It's a pretty powerful program. So who qualifies for it? They have to be Canadian resident, at least 18 years old, and the oldest they can be is 71 to open that FHSA, and they have to have a valid social insurance number. Okay. They have to be a first-time home buyer. So no home ownership in the opening year, no home ownership 4 years previous. And it has to be a principal residence qualification, and their spouse ownership restrictions may apply as well if there's a spouse involved. The account limitations is you can only have one FHSA per person. So it's not like a TFSA where you can have multiple. You have one in one institution. You cannot reopen one. You cannot do that. There are transfer restrictions that apply. That's more details for later as to what you can transfer in and out of. And it has to meet the CRA definitions of a first-time home buyer. The tax deductions, or sorry, tax advantages. So deductible contributions, as I mentioned, as the FHSA contributions go in, they are tax deductible and they will reduce your annual taxable income, which is great, similar to the RRSP contributions. It is tax-free growth, so it grows in there. So it's important to have it invested properly so you get growth. But the great part is your 8,000, if it grows to 9,000 a year, you're not getting taxed on that extra $1,000, right? They're not going to say, oh, you made $1,000, Sandy, so now you owe us some money on that. It grows capital gains free. And it's tax-free withdrawals. So again, as you take that out, it's not taxed when it's used for the house. Whereas an RSP, if you're to take that out, it's going to be taxed, or it has to be paid back if it's into a mortgage. Qualifying purchases must be a principal resident in Canada with a written purchase agreement and the intention to occupy the property for 1 year. So, or within 1 year, sorry. So when you buy that property, they are expecting you to move into that property within the year of purchase. And the withdrawal must come 30 days of, so you're taking the money out of that within 30 days of occupancy or 12 months after signing the purchase agreement. Typically that's going to happen anyways, because you need that money in there before you take occupancy of a new home. But there are those guidelines they have to put in there just in case. So what if you don't buy a house, right? Who knows what happens? Houses are expensive, or maybe you don't save as much as you want, or maybe you decide to live in a different country, whatever the case is. If you decide that you're not going to buy a house and you've now established this FHSA with $30,000 or whatever the amount you have saved up in there, what are you doing with this money? It has to go into a new home. If you're not purchasing a new home, then you now need to transfer that into an RRSP or RIF if you're over the age of 71, which is great. It's tax-free. They're not saying, oh, you got to take it out. But you can transfer, if it's not being used for its intended purpose, which is to buy a first home, then you can transfer that into your RRSP or RIF without any tax issues. The account will close at the age of 71. If you're maxed out in your RRSPs, that money can still go into your RRSPs. It's not going to be penalized because you're already maxed out on RRSPs. And the unused funds will become taxable if you withdraw them directly. So if you just say, well, I want to take out my $40,000, put it in my bank account, you are going to be taxed on that at that time, because it can't, again, the intended purpose is to buy a new home. So you can, you can avoid those taxes by just transferring it properly. So again, this is just a breakdown of what I said. You look, there's a lot of yeses under the FHSA. The only no is a positive no, right? Tax deductible, free withdrawal for taxes, used for new home, and there's no repayment required. Whereas an RSP, you do have to pay that back within the 15 years. The cool part of this now, which is fairly new from when the FHSA first came out, it was going to be either or. It was going to be you either use your FHSA or you use your RSP, so you were limited. In this new program, the changes to the program, they allow you to use up to $40,000 of your FHSA, as well as up to $60,000 in your RRSPs. So that creates an amount of $100,000 that if someone has maximized these two programs in savings, that they have $100,000 now to put on their house. So if you look at a couple, you say 8,000, you break that down. Can you put this much a month away each? That's 16,000 a year. They can each put away, right? So think about it. We're up to like $200,000 if it's a couple and they're both contributing fully to this. So you guys know better than me if you need $200,000 to put down on a home, but it's, you can use your FHSA over the RSP if needed. Where can you open an FHSA? All major financial institutions, so banks across Canada that offer FHSA, and investment specialists such as myself, that's going to work with you to make sure you understand the program, to maximize the FHSA, to say, hey, it's a new year. Are we contributing to that FHSA and not miss a year of contributions? And is going to invest that properly for you so you see growth. And you can also open them up at local credit unions that offer that option. Investment options are high interest savings account. I don't recommend those, but those are for people that are, and GICs that are super nervous about losing anything in there. You do have 5 years if you're going to maximize it. So you do have a little play to go into some moderate investments that are going to help grow that. You can put it in mutual funds or exchange traded funds or individual stocks and bonds for those that are day traders themselves and want to play the market themselves. To me, the middle one is the best option. That's what I work with. You're putting it into a mutual fund that has great risk mitigation, but also some great growth, right? To get you up there. And basically what would happen is you're invested and you've got maybe a bit of a medium risk. The client says to me, hey, I'm going to buy within the next year. I'm going to take those funds and put them in something a little bit more stable so that there is no chance of loss at that time or decrease in their account, right? So hopefully in the end, they've put that money in there and they have made some extra growth on there that's going to also help them out. And then selection, who do you want to work with? What do you have to consider? You want to look at fees, of course. You want to look at transactions. A lot of banks will not only charge you to open them, maybe not open them, but to put your contributions in. But when you take that out or you make that transfer, there can be fees involved. So you want to know what those fees look like everywhere you're in any transaction costs. Evaluate the available investment options. Again, you put it in a GIC, it's locked in there for 5 years or 4 years. You're going to maybe make 2%. You're not going to see any growth. Anything you do see, you're going to be no, you're not going to be taxed on FHSA. But any growth you see is going to be minimal as opposed to putting it into a proper investment vehicle like a mutual fund. And you want to look for someone with personal service because this is one of the biggest, well, it is the biggest purchase of your life, right? You want to make sure you're in the best position possible so that when that transaction happens, you've invested properly, it's grown properly, and the person that's helped you from day one is the one that's going to be celebrating with you when you get that house. Right? That's for me, that's the most exciting thing is when someone actually purchases the house and they get to move that money into their mortgage. So exciting. So those are important things. So high level for you guys as agents is just talking to potential clients. Maybe you're working with someone and they have adult children and, oh, my kids will never be able to buy a house, or they're interested, but they don't really know how to save. That's your conversation at a party. Yes, I help people plan, save for the future, or sorry, I help people purchase homes for their future and give them the life that they're looking for. But I also help people understand how to get to that point, right? I'll give them some education on the first home save. Have you heard about it? And you can say, it's not my area of expertise, but I want to tell people about it because there is a good option out there for them to start saving for that new home that you hopefully eventually will be the person there to help them buy. So we've got 5 survivors here. Thank you. 4, I guess, including me. It's a long session, a lot of information. Again, Andrew, I'm more than happy to focus on a specific area if you get feedback or if people do watch the playback and they want more information, or they can obviously contact me. But whatever you guys are looking for, yeah. Bring it on.
Thank you, Trish. Appreciate it. And yeah, guys, if you don't have insurance, life, disability, etc., please plan some time. Also, if you have insurance, you don't like the product or want to have a review, Trish can help you with that too. That's how I started with Trish. I had life insurance already, but I did not like the product. We went through it and I ended up switching over to something with her. So I'm a lot happier with it now. But yeah, there's so many products out there on all these fronts. So just make sure you have a conversation with somebody that can help you on there and that you're protecting yourself and your family. And a lot of us on the team have kids or will in the future. Just remember, life insurance is cheaper the younger you are. So it's good to start a plan younger when you can.
Trish, where would I find your contact information?
I'll put it in
And
school.
Okay.
Yeah. And I'll post it on the